Hello, friends, fellow traders, and investors. Thank you so much for your continued support for Sunday Stock Storm and joining our session for the day. Today, we are going to do something different, take a look back on what of the episodes we have done and also how to apply all whatever I have showed you from my bag of tricks. As I plan to do 52 episodes and we are in the 26, we are in the mid journey, and similarly 52 again we'll do another review. So this is a review on how you should approach this, how you should apply the Sunday stock storm with your existing trading and investing plan. But before all that, as you know that storm is divided into three parts. First, I take a look at the overall market condition, and then to the topic discussion of the day, and finally take up your queries on individual stock. Please note that here in this analysis, I'm either going to use the line chart or my specialized chart, that is fountain of gold. Those who are joining for the first time, please note, like you have found it today, always under Sunday Stock Storm, you are going to find the link on this page. And if there is a mistake from our side, like last time the link disappeared after the class started. So if that is happening, we will release the episode publicly. Largely, as of now, all the joinings are free. However, recording only remains for the YouTube members. This is the page, and also you can keep on a regular check on the offerings. Like we recently had closed the trials, but along with trials sometimes it comes as workshops where we add up along with the trial knowledge which can be useful. Like we have done it for bonds, done it for options, and in future I plan to do for international foreign exchange as well. So keep a regular check on what is the going on. I'm expecting to do macro learnings in the future. Now let's get back to the discussion how you should approach the market, or rather this is about how I am approaching the market. Possibly I have mentioned already in the past storm that in my international portfolio, and also if I consider the domestic, significant portion of my portfolio I have moved into bonds. Since then a correction has come up in the US market as well, but that part was not fully known to me, but there was a possibility. So I'm basically has gone into more defensive posture. Now bond has means cash instruments are large part of the portfolio of mine, and more strategic investments like going into natural gas, base metals, which will show less of volatility than individual stocks like ETF I can try for, etc. So this is a general what I am broadly taken the approach, because we are, I believe, in the late part of the cycle as shown by my risk master here. We are, the recession risk is high. I'm not expecting, does not mean that tomorrow the recession is going to come, but I think it is could be close by. So considering that risk, I have more take a defensive posture in overall stance. Trading is different, that is commodity options are going as usual. But in my investment portfolio, I am now significantly way more defensive than I was previously. So first I keep on checking a look on the stocks risk, because risk is the most important factor. If we can risk and try to do the opposite, means when it is the risk is rising, let's play it defensive, let's approach it this way, and when risk is on, we play aggressive. This posture alone, I think, can lead me to overall outperformance. In the weekly chart, I still do not see significant rise level on the risk, but it is forward risk is rising. So certain level of risk aversion is there in the financial market. Next, what I do, I'll bring the line chart if you want, it will help. From the Nifty, we can clearly see it is in a bullish trend from the line chart. The basic learning, the Dow structure. Now the daily chart, I can see that the drawdown risk is accelerating, but is nothing flashing red yet. So it is not significantly high. Second meter, any turmoil in the market, which is currently happening in Nasdaq and US stocks, may not sustain for a very long time. India risk is remains similar, elevated. Smart money is not going for aggressive, means high growth stocks, risk aversion, but nothing to be extremely serious about. My stance is more strategic. I'm ready to wait for a longer time. That long can be for me 6, 7, 8, even 1 year. But I'm ready to take that defensive posture because now it seems more way overstretched, cloudy given the scenarios, geopolitical, etc. So I'm not sure about the kind of return equity market can give me. So I'll rather use the bonds to be assured of my return. And for other part that I'm going into, say, natural gas ETFs, these will provide me the extra return that I need. So global equity short term, I can see significant risk is high. And naturally, Nasdaq, S&P is correcting. India risk has gone up, but not necessarily, and more positive, forward risk started declining. This was elevated for some time. Now the downside risk is in decline forward, means for the upcoming weeks to come, say approximately say 2 weeks, that is good positive news. So that means in this round of correction, it is possible that Nasdaq and US market corrects while India can continue to find a base. What can give our market special tailwind, means forward push, is if there is a trade agreement. Later market will get to the details of the agreement, but if there is agreement, we don't know, then we can get that extra push. So this should be, means the extra push on that news should not come as a big surprise. Now after this, as I have already done and taken a look at the daily and the 125, I'll now go to the rainbow setup, main index setup, and look at now the overall condition of the equity market. Nifty, after the correction, I have received a full green candle. This is positive overall. So India, there are chance, good possibilities will happen. I'll continue to participate. My stance is currently more aggressive towards the international market, especially the US, whereas there are opportunities still going on in the Indian equity market. So after the correction, I've received a full price action bullish, but lower meter is showing that several of the international markets started suffering. US market, special weakness in S&P and Nasdaq, Dow is less weak. Euro stocks, means some of the European blue chip still rising. Italy was very strong. Italy market, if I look at ITA, say 40. No, this is not the right one. So overall, Italy market has been bullish, but in this time frame overall. The readings will change depending on the time frame. So Italy is starting to look weak, Spain is still strong, Germany is declining, China and Hong Kong is now showing weakness, Nikkei, but the rising one is the Nifty. So Nifty, European blue chip, Spanish index, some areas still strength, but US market along with big Europe market, that is Germany, is now weakening. So this is the Nifty weekly chart. After that, I go to the daily chart, and this is very interesting, a rare pattern in my setup. A full squeeze, almost no candle means full squeeze, and likely usually after squeeze, certain time there is a burst. That means one side likely there could be a burst. Both side possibilities there, because if global market weakens, there will US market weakens, there will be downside pressure on Nifty. And whereas there is the possibility of trade agreement and tailwind. So both side possibilities. So little defensive stance on the trades means not aggressive breakouts, or breakout means the stock which has gone already quite far, not at the breakout level. So entry should be taken care of in these markets. And also focus of mine is where the weakness is coming from. I don't want to remain with the weak stocks at this situation. Now I'll go to the 125 minutes chart. I can see a base formation going on. Overall looks bullish. In the short run, only the Nifty, Spain and Italy rising. But white cross in my means outside candle body is giving me warning. So Nifty will be more stronger when it crosses once again above 26,000. That means it is definitely now going to challenge this 26,100 and very likely can break into a new high. So Indian market, some positive vibes overall in the 125 minutes chart and also in the weekly chart going on. But next week, I expect, looking at the overall situation, from Monday onwards, we'll start seeing jump on the up move. That may not be the case. It may take some time, create base, and very likely we'll get the judgment what's going on in the next 4 to 5 days. Let's look at what is our option master is suggesting right now. As I had already suggested, if I get a price action neutral, it will be good to move away from the aggressive bullish trades, which are bull call spread. Currently, more defensive bullish trades are going on in my setup, that is bull put spread, income strategy overall. So I still remain overall bullish in the 125 minutes chart, with the probabilities suggesting more range bound bullish market. Means bull call ladders could be more better strategies unless we get the breakouts of 26,000. And that will make sure the yes, Nifty is once again strong, and first signal will come if Nifty starts to break the main index above, once again going to test 960 crossed and testing the 26,000, holding up. That will be a good signal that yes, the bulls are strong underlying. So we have to know the present, what is going on. That is what my approach. I don't need to know the future, but different ways we have to know the present very well. So now to get the present into stocks, Nifty 50 is not the right index. This is a very good index to play the derivative, blue chip, less volatility. But for stocks, we have to focus on the Nifty 500 and into the more detailed chart of sectors, etc. Nifty 500 is similarly just like Nifty around, it is strong. A full green candle in the weekly chart, so underlying strength is there. Those stocks which are turning out to be leaders, they will outperform and likely still good enough to try out on the Indian side of the stocks. Whereas Nasdaq, let's look at a quick Nasdaq comparison. This is the weekly chart. I have not seen this kind of weakness in a long time. So now India could be still, if juice is left overall the market, India could be the one doing well. At least it is holding up good base. It has a good possibility of a good news of a trade agreement. Now we'll go to the mid cap chart. Sorry, this is not the mid cap. Just a moment. Last few storm I've been highlighting the portion of the market that has been strong is the mid cap. And in the base, it is clear from the candle that it is giving the breakout. So mid cap segment of the stock current market is strong. So if we are investing in any kind of market, I will look for where is strength. There are the leaders who are strong. And I think if Indian markets continue to show the strength, mid cap will be the segment that is going to outperform. That means we have to look for which are the mid cap stocks. Nifty 100 to Nifty 250 up to the stocks, those are mid cap stocks. That we have already learned in the previous storm. And I have been highlighting the segment of the market that is not well is the small cap. If we take a look at the Stockage app, and take a quick look at the mutual funds. Last time we talked about mutual funds. Mutual funds in the say last 1 year approximately, small cap is not doing well. Where is the small cap? Yep, 1.8%. Average mutual fund. Whereas large cap has done better. And mid cap into strength. This is not a suggestion to go jump in the mutual funds. It is a basic showing where the strength is. And weakness is persisting in the small cap segment. So, in the portfolio, you have to think about that you are the gardener. This segment is going bad. That means there are bad weeds. You have to remove them from the portfolio or reallocate some of those investments into where the strength is happening. So we have now clearly taken a look at overall market situation, what it is. We remain somewhat bullish biased, though we are understanding the headwind, means opposition force coming from the global market. Whenever US market is down, that adds pressure. Whereas India underlying, it is humming well. And which sector is so far the best? Looks like the mid cap segment of the market is currently the strongest. And opportunities are not just happening in the Indian market. All these big movements and whatever we are seeing, it is 7%. the Sensex in the last 1 year. Whereas there are market like even available in India, the Hang Seng Bees is up 30%. So improve the return, we can look beyond India where opportunities are happening. Now, we will now close this part of the discussion, that looking at the current market condition overall. Now, the last one few things I'll take a look at this time, which I have not done in the past, is I will take a look at gold and silver as well, because those remain important part of investor portfolio, gold bees, silver bees. I'll choose the setup to be commodity, and largely we are talking about the investment. So I will open up the SIP manager. What is should be the SIP approach currently towards gold silver? So for gold bees, silver bees, we don't use the gold bees, silver bees chart. We use the main chart, which is the India Mega Gold or Gold Mini, whichever, all both are fine. So I'm using gold mini chart, and here I'm going to use the risk master. Under risk master, so weekly chart is the approach in case of gold. I do not see any kind of change. The continue to invest should be done, and full hold the setup is suggesting to me clearly that gold I should remain invested. I can make it more tactical by, if Nifty becoming stronger, that's different. But if gold is taken individually in our portfolio, we will continue to add the gold. Also, I'll take a look at the silver. Silver mini can be used. Continue to invest. So I don't see, but I always prefer gold over silver in a long-term portfolio. Now, this is the situation with our investments. Now, I will move to the topic of the day, that is looking back to the previous storm, and to also understand how you should apply it, those who have taken note what we have shared in our storms. It did not started as it is currently going on. I did not fully plan this. So first two episodes we have discussed about the broad market and overall condition, like what could be the recession risk of this time and how the environment going ahead, which will be different than the last 30-40 years what we have seen. And then we move to the more topic. The first was definitely to discuss the general risk management rules, like if we are trying to improve in our trading. Just a moment. These are the four pillars to work on. One is the knowledge part, under which I am taking up topic under stocks, which is could be largely company specific, industrial and sectorial. This part we are focusing on the Sunday stock storm, regular discussion, and these are the other areas. In this part, we are also taking a approach to the risk in the Sunday stock storm, and through your stock discussion selection, we are somewhat focusing on the timing part and time part of it. So largely these three pillars we are focusing on. So some part of the storm is catered to this area, you have to understand it clearly, and some part means like market cap magic we have discussed, small cap are the best performer when the bull market rising. Then within the small cap, you can understand, okay, based on the age factor, how I can remain diversified. Basic. That means that is coming under risk management part. So that is the focus of today's storm, taking a look back and help you get this idea how to place. In the topic, we have covered that usually means one in a case is okay where some other conviction may be going on, but largely into stocks, it is not good to bet more than 8% loss. That is about the perfect loss. It is not a great idea to go for a bet on an earning day with anything more than a 5% stop. If the stock has stretched too much, giving you 25-30% within a short period, say few months, on earnings day, a 5% stop is very useful. So these other general risk managements, they were discussed in our episode number 4. So you should note down, if you are regularly watching or taken note, this should come under the pillar of risk management, the general risk management rules. Now these two are very special. Our common pattern means these are about the timing and also about choosing which stock. If you can largely, these are the first important patterns that I've covered. Dow structure along with head and shoulder, double bottom, other variations, given out important statistics regarding them. Now once you see, say for example, we discussed about overall market is strong, say strong, getting humming strong. One of the possibility could be bullish, bearish also, but bullish looks like the present condition. Then I have to choose within that present condition. We saw, okay, mid cap is strong. Okay, mid cap strong. Now it can come down to which stocks to buy. Without, for now, we are pausing the fundamental other factors, PE, etc. But timing wise, which is basically the technical analysis, is timing wise, you can use these two patterns that we have discussed. Also, those who are rainbow members, you have the signal in our event pattern, similar here. If you use these patterns, your performance will significantly enhance. Means I don't do anything else, I only look for these two there, I'll sort them out. That can significantly improve your entry and timing, not chasing the stocks which have already gone. When a market is coming back, in some corner of the market, this pattern is definitely getting formed, because that's why they are common pattern and they provide very, very uncommon profit. Then we have moved to, okay, position management. Not entry is the one thing, how it behaves after that, the pattern. Like in our, say, inverse head and shoulder pattern and double bottom, many time market will come back to the breakout level. So how you do position manage, where to put the stop loss, how you continue to ride after the pattern, we have taken up to till episode 7. Then I decided that I will also add about the fundamental tricks. So I talked about a general approach of finding a strong business. It still may not be the outperformer, but on the capital employed, the return ROCE, a 20% level, generally considered across the fund management, it's a great stock. But this topic I will revisit now in the future storm, more fine tuning it. What could be a better levels to look for through the PE ratio, PB ratio, etc. Event pattern. Earnings keep on coming, stock split, demerger like happened in Tata Motors. So how we patterns are formed around those events. We discussed focused more on the earnings. I plan to do another part in future on the event pattern. Then in the mid-year or the beginning of the year, you have received amount of, say, money to invest. So we discussed in this one a particular way. Along with these two were like your entry given common pattern, then the money management part. And here another method was discussed, belly of bear. Two ways around the mid-year, July, how to look for belly of bear means anybody's belly is very soft area, no major bone. So when you put a sword through the belly, it easily will go to the opposite side. So belly of bear looks at another entry method into stock investments. Now this topic was so important, the stop loss, I had to revisit this again, and possibly will have to revisit it again in future once I already did that general risk management for stocks. And here for YouTube members, we have shared the trailing stop loss available only for the YouTube members. I recently cannot make not many videos for them, so it remains as a special thank you for to those who are avid followers. Then always what a general crowd tries to buy anything cheap. Anybody using even the rainbow setup, you get a sensation when you get a buy signal after a big drop. So this topic had to be discussed. Does this buy cheap, does it work? Then how cheap we should look for? Someone is saying screen has stuck, so I'll screen once again. This is buy cheap, buy expensive. Means cheap buying work. Should we look for stocks which are cheap, or कुछ लोग बोलते हैं buy 52-week high stocks? Does that work? If work, generally what kind of profit can we expect? So episode 12, take a look on the buy cheap, buy expensive part. This was first topic we took, buy expensive. So how expensive stocks we should look for, like those stocks which last year has gone up 100%. Means on the December, this work comes in December. Which stock last year has gone down by 50% or more? And those who are, say, rainbow members, say urban cap, if it down by 50% in 1 year, and after a while it is giving a rainbow buy signal, then it could be a chance, an entry opportunity. Or those who are not rainbow members, when you after a long time see in the urban co a Dow structure or an inverted head and shoulder or double bottom, that is your opportunity to go in. But either way, we will have to wait for the right moment to strike. Then if many people use the candlesticks, And one part of candlestick is the spikes or wick or shadow, kate. So spike is very important. Those who study candlesticks before going for the candle pattern, like in the anything else in technical analysis, you go for the Dow structure first, practice it enough, then you go to the next level. Similarly, from a candlestick, before you move to bullish engulfing, bearish engulfing, you have to first learn the basic candle statistics and or basic candle analyzer. Then you can move about candle patterns. So I talked about the importance of spike. However, certain candlesticks are so important and such is their strike rate, it had to be mentioned in the calamity candle, a bearish engulfing. You found an exit. If you are looking for an exit, this one definitely an exit. So in your exit rule book, this can be included. How do I exit? I found one Dow structure. How do I exit? From the Sunday stock storm, found another calamity candle. Then before I could move to the fundamental discussion, which once again I'll cover the basic of income statement. There are deep knowledge is possible, but I am looking for to build the first workable knowledge. So we covered the basics of balance sheet from banks, manufacturing segment. So broadly the main segments we have taken a look at how it is structured, what it basically shows. Then we could start with the tricks. Market cap magic. Like small cap are underperforming, it was very, very natural. Because small cap mode to be bought when the overall market condition in a bullish or after say mega crash it is coming back, small caps do very well. Last say after COVID, while Nifty was giving say 17-18%, small cap gave 30-31%. Now we made the market cap selection little improved when we added this debt condition with the market cap. Like a company in the small cap could be raising more debt, Swiggy, will it outperform? Or there is another one paying debt, will that outperform? Or one debt where it is neutral? Is Britannia taking debt or loan? Is it good? What about Adani if it is has too much of debt? So debt topic we took a look at in the episode number 18. Then once again we went back to the topic pillar second. Here the second pillar. Second pillar, this was covered buy, wait and win. And I gave you actual data based on JP Morgan and other analytics that longer you tend to hold a stock, greater the chance comes down of you making a loss. No point looking at the profit because profit part is unknown. So it was, I tried to suggest, and which I will still suggest, it is weekly chart that is the best for stocks, best for pattern wise, holding wise, and stocks demand that patience. Where your trading part you can satisfy with a lower capital by trying gold, silver, Nifty, and they will be sufficient to give you the extra push that you need in your portfolio. or you can go for different international investment to boost your portfolio. Now, this topic came under the pillar number 3, risk management and money exposure. Like at the age of 65, where you may need the medical money more quickly, going into stocks, which if it is in a bad time, may not be enough. So I suggested there are many ways to do diversification. Complicated Harry Markowitz model of portfolio selection, and I suggest in another allocator's age, which my simple a different way to look at. This is another way by the age factor. How much you choose debt, how much you choose equity, and overall the portfolio. Suppose 10 lakh, your age is 35, you will choose 65% equity and 35% debt. And this whole 10 lakh should 15% of this 10 lakh, 1.5 lakh at least, or up to 20% should be in the gold. This is a very good general structure. Now you can have to decide ki from this 65% at my age, how much should I make it passive and how much will I make it money wise active, like having different production line within your business. One portion can go for SIP, and in SIP we have taken a look at ki this vital question, mutual fund sahi ya nahi. A general conclusion मेरा था कि सही, but majority and all almost will underperform after fees. The market. It is going to happen. I've given you actual data. So mutual fund may be sahi for investors who are not able to make any money, negative. Even in that case, majority case, 97 to 95%, in the long run, ETFs stand out. Let's look at whether this is true or not with actual data. Which segment gave the best in the last 1 year? The large cap, 9.5. And this is basically Nifty index fund, the Nifty Bs, 11%. Overall, large cap could not beat it. So our focus should be how we, with this approach, we can beat the or try to beat the overall market return in the long run. Then you are doing anyway better than the mutual fund. But if you choose, no, at least I want the market return or the best market return, then it is best to go for ETFs than the mutual funds. And very low cost, the lowest one to choose. How to choose between ETF? The lowest cost. Now, money management remains important part, and I have discussed different ways to do the money management approach ki in your individual stock portfolio, how you can decide to money manage. Another I will discuss later on about based on volatility, fluctuation. Different stocks moves at a different fluctuation. So I will discuss money management, another topic later on based on volatility, how you choose how to invest into individual. Ki Reliance itna quantity, Tata Motors this much. So this is where we have come till this point. Mutual fund episode 25, and today's episode I have taken a brief look at these topics and highlighted clearly now that under this discussion Sunday stocks term, we are largely on focusing on the core competence, this part, certain part of core competence 2, and also core competence 3 part. So that's all, friends. Thank you so much for joining today's discussion and taking the effort, being regularly present. So I'm ready to for any particular stock related query, but you should not regard them as investment advice, because then the best first mistake will happen. Risk management rule number 1, that we don't listen to others in our trading decision making. You can't do that. You can apply simple methods. If you are not unable to comprehend candlestick, you can go with the line chart as well. But rather, if you want, you can do the make a person say portfolio manager, but it is very, very difficult to find will be the one who can beat the market consistently. So first screen is, please explain rainbow squeeze candle and how to play it. It is not part of right now, sorry to say. You can ask in a rainbow class. These are different rainbow pattern we have discussed, like certain inverted head and shoulder will fail, but you can filter them out better if we get a rainbow buy signal, particularly within a time period along with the pattern. So, or where it is exactly for me. So it would be covered in the rainbow class, sir. It was not a topic of this discussion. IMFA and IMTA take. First, I will take a look at the overall weekly chart. It is significantly strong, already firing. The best entries are gone. Now, if you enter, can this stock go up? Yeah, definitely it can go up, but also it can go down. That is a possibility. And when it's going up, you have to project what makes level logical. I don't have to draw Fibonacci to understand this. 1500 is the psycho level. That's where the fight will happen. That means if I enter now, it can fail the breakout. I can understand what is the breakout level. That is where any breakout can come back to. That means 1200, 170 rupees on the down, and possible and more, I don't know, but 130 on the first key resistance. So if I have missed the best entry, I don't think I'll continue to ride. Daily chart wise, yes, there is an entry. After correction, another buy opportunity. So it can be entered, but we have to keep on the check for the momentum loss. So entry level stock is strong, but any new entry is no longer there. Beautiful entry, rather put it like this. But so if you are ready to search for, rather than what is gone, you can find investments which has lower risk and can give you your required return better than market return. So here is I can see the IMTA Tech, and it is up, but it is losing the strength. So gradually it is going up. It is another strong stock, and it has challenged our main level. This is the main level. Some struggle is likely around this area. Along with that, I will draw some important lines on the IMTA Tech. This is the level. So I think in this zone, it will make a stopover. Thoda pause dene wala hai, and after that, we'll know what further will IMTA Tech do. When segment of Rainbow member will open on your website? Rainbow member special section I was expecting to open in November, but I think we have rescheduled it. We want to launch it right. Do not hurry. If time is needed, we'll give it. So I think I'll try for the new year. Anyway, all the current recordings are available. This is I plan to make special like Forex, some basic knowledge addition, etc. Like commodity, I have already done it. I have prepared the videos here. So commodity brokers, it is going on. So basic knowledge addition, I'm doing extra. But majority of our strategy videos, that is commodity positional strategy, intraday, these are already available in e-learn markets. So you basically have all the necessary recordings for the time being. Bank of India making cup and handle breakout in monthly chart. Monthly chart is too long. Question is, will you be able to hold that? Monthly chart is very, very long term chart. Like if you have, even look, we have to ask, is it really if you were that long term investor? Like I'm not. And if the answer is no, is it then the trade you are just trying to justify because you may have missed the run? Would it be that? So we have to see, this was anyway rainbow pattern was there one. Monthly chart, yeah, it has potential in the monthly chart. Not a very beautiful pattern at the moment if we call cup and handle. You can consider it as a cup and handle, but not a very beautiful one. A very clear one not there. Usually the cup and handle pattern will be almost very, very nicely cleared with the rainbow. It has lower base, but it has potential, no doubt about this. In the monthly chart, if you are really a long hold, this stock may have potential, but it can also possible, because if when you buy a stock at this level, on the left hand side means there remains a lot of sell orders, because a lot of people have held this up. So if you understand common crowd psychology, you will understand that people will hold the loss but not into profit. So naturally, if it more it goes up, those sellers will come in. So if you are a monthly chart holder, means suppose if you are using the rainbow setup, you can see your stop loss is coming currently max is 105. That is almost a 30% drop. And possibility of gain is also quite significant. It is not small. It is 100% gain is possible. But it is not clear at this point that it is for sure, means not given for sure, and more importantly, it can take longer time. So you have to see whether you are fine with that. If not, then there could be psychology issues going forward. You have to be very clear about plans. Endurance take after good result come out, take follow. What should be our strategy? That what I discussed in the event pattern. If you follow that event pattern strategy along with our common pattern that we discussed, it is significant. That is, people fail to understand. First of all, is this result is a quarterly, it's one of the delayed data. Look, it is a very old data is coming. It is maybe new to the market altogether, but very old data. What it has to do now? Suppose you got your finger burned, and the doctor said, "Hey, I looked at your finger 3 months ago. It was okay. It is okay. No problem." Things have changed, might have changed. So endurance, many times this is a trap. It's the stock goes, especially I remain careful with the stocks which goes up before earning. And I love the stocks the most which drop on the earning slightly, 5%, 7%. Then within few weeks it break out on the upside, opposite side. those are one of the best, because somebody looked at it differently. Despite the bad result, somebody